They just told you everything is fine. And in the same breath, central banks are doing the one thing you only do when you don't trust the system. They're hoarding gold. Not tomorrow, not someday. It's happening now. And 2026 is shaping up to be the year the buying turns from steady to desperate. Because here's what actually happened. The biggest players on Earth have been quietly swapping paper promises for metal. And the next wave isn't just governments. It's regular investors, people who sold in 2024 and most of 2025, about to stampede back in. We're not watching a chart. We're watching a confidence collapse. And if you're holding gold or silver, you need to understand one uncomfortable idea. The price isn't rising because gold is magical. The price rises when currencies get exposed, when the mask slips, when safe turns into fragile. Now watch this. Central banks don't buy gold because they're bored. They buy it because reserves are supposed to survive storms. And dollars, euros, yen, those are umbrellas made of paper. For years, the story was simple. The dollar is the cleanest dirty shirt. But we're past that. The shirts are dirty, the hamper is on fire, and gold isn't even in the room. Gold is the exit door. So what changes in 2026? More central banks keep buying. That's the baseline. But the bigger shift is the ones who hesitated, who watched from the sidelines, finally taking the plunge. Not because they suddenly love gold, because they're watching other central banks win. And central banks don't copy trends, they copy survival strategies. Here's the part most people miss. This isn't about inflation as a buzzword. This is about trust. Reserve managers wake up every morning and ask one brutal question. If the world cracks, what still counts? The Treasury bond is a promise from a government that already owes too much. A fiat currency is a promise from a central bank that already printed too much. Gold is not a promise. Gold is the thing you hold when promises start sounding like bedtime stories. Now, there's a second engine turning on, and it's the one that could make this move violent. Private investors. The same crowd that dumped gold when headlines got boring. The same crowd that chased the next big thing because it felt faster. The same crowd that got tired of waiting. They've been on the sidelines. And they've been watching gold keep marching while everything else plays musical chairs. So ask yourself, when the public comes back, do they come back gently? Or do they come back like a crowd rushing one door in a burning building? Because markets don't move on logic. They move on positioning. And if enough people are underweight metals going into 2026, the catch-up trade can turn into a chase. And the chase is where the real spikes happen. Now let's deal with a number nobody wants to say out loud. If gold doubles from here, just doubles, it puts it around $8,500 an ounce. That's not a prophecy, that's simple math. But here's the poison hidden inside that math. Even if the stock market stayed flat in dollars, you could still be watching a massive collapse in real terms. Because if gold is rising that fast, it's not gold going up. It's the measuring stick breaking. Think of it like this. You can brag that your house went up in price. But if the currency is shrinking, your house didn't get richer. Your money got weaker. So when gold rises hard, it quietly rewrites what up means. And that's why you can have a stock market that looks stable, while it's bleeding out in real value. We've seen this movie before, just not with this cast. When you price stocks in gold, the decline over decades is brutal. The nominal numbers hide it because we keep inflating the scoreboard. But the metal doesn't care about your scoreboard. Now watch the next move, because it's the one that snaps the whole narrative. The world isn't rotating out of the dollar into the euro. It isn't running to the yen. It isn't hiding in the pound. It's moving out of the dollar into gold. And once you see that, everything else makes sense. Because if you're a country sitting on a mountain of dollar reserves, you're sitting on exposure. You're holding someone else's policy risk, someone else's printing press, someone else's elections, someone else's debt spiral. So you swap, quietly, patiently, month after month. And when enough countries do it, the flows matter. Money that would have gone into treasuries doesn't go. It goes into metal. And that changes the game for interest rates. Because here's the dirty secret. The system needs rates low. Debt needs rates low. Governments need rates low. But the market doesn't always cooperate. So what happens when the market pushes yields up? The central bank steps in. It doesn't call it panic. It calls it policy. They print. They buy. They suppress. They can swap the label from quantitative easing to liquidity operations or T-bill purchases or whatever brand they want. But it's the same move. New money, old bonds, a bigger balance sheet. And every time they do it, they're telling the world, we can't let the price of money be honest. Now here's where it gets spicy and where the headlines are going to try to confuse you. People will say, but if everyone is printing, where do you go? Exactly. If you sell dollars and buy euros, what did you actually fix? Europe has its own debt and its own politics. Japan is a different flavor of the same problem. The UK has its own mess. So the choice isn't dollar versus euro. It's paper versus metal. And metal wins when paper starts arguing with itself. This is why gold is becoming the settlement instrument again. Some countries are already settling trade in gold. Not because it's cute, because it's neutral. It's universal. It doesn't require permission. You can net out trade flows and settle the difference in a metal nobody can print. That is a direct attack on the dollar's role. And when the dollar loses that role, it's not a gentle decline. It's a confidence event. Here's the open loop you need to hold on to. If the world decides gold is the final settlement, what happens to everything priced in dollars? We'll come back to that. Now, let's talk about the question people ask when they're trying to talk themselves out of owning gold. Won't they just use something else? In some cases, sure. If gold is optional, people substitute. They use other metals. They engineer around it. They cut corners. But there are cases where gold is non-negotiable, where it's the only thing that works, where conductivity, corrosion resistance, reliability, there's no second place. And in those cases, the buyer doesn't negotiate. They pay. That's what makes gold so dangerous to the paper system. Certain demand is price insensitive, and central banks know it. They don't want to hold an asset that depreciates by design. They don't want reserves that melt while they sleep. So they swap into the one reserve that doesn't have an issuer. Now you might be thinking, okay, but can we trust the countries doing this? We don't need to trust them. We need to observe them. And here's the observation that keeps showing up. Some countries likely have more gold than they admit. Why hide it? Because if you're still buying, you don't want to advertise your position. You don't want to push the price up against yourself. You buy quietly, you report slowly, and you keep your cards close. That's not conspiracy. That's shopping. Now here comes the twist that could blindside a lot of people in 2026. Crypto. Not the ideology, the flows. There's a big difference between early adopters holding keys and latecomers buying ETFs because they heard a slogan. ETF buyers are tourists. They came for the fireworks. They don't have decade-long conviction. They don't have deep profits. They have expectations. And expectations are fragile. If you bought a fast horse and it starts walking, you don't give it years. You swap horses. Now imagine you sold gold and silver in 2024 and 2025 to chase that faster narrative. Imagine you watched metals run without you. Imagine you watched miners rip while your new bet stalled. That frustration is not a feeling. It's a future flow. And flows move markets. So in 2026, one likely setup is a rotation. Money exits the stagnant trade and rushes back into metals that are actually moving. Not because everyone suddenly becomes a gold bug, because people hate missing out more than they love being right. Now, there's another pressure point in crypto that most people don't talk about until it's too late. Collateral. Early holders, people who bought cheap, often borrowed against their crypto instead of selling. Why? Taxes, sure, but also because they believed the future was higher. Borrowing feels smart until the collateral drops. If prices fall, margin calls don't care about your philosophy. Loans get called. Collateral gets liquidated. Forced selling kicks in. And forced selling is the kind of selling that doesn't wait for a good price. It hits the bid. So you can have two things happening at once. Late ETF money leaving because it's bored, and leveraged holders getting forced out because the math demands it. That's a headwind. And if that headwind hits while gold and silver are pulling capital like a magnet, you get a psychological stampede. Now let's bring silver into the room, because silver is the metal that loves to embarrass people. Gold moves like a battleship. Silver moves like a street bike. It's smaller, it's more volatile, it's more emotional, and when it runs, it doesn't jog, it sprints. A move to $100 an ounce in silver isn't impossible. It's the kind of move silver does when the market wakes up late and tries to catch up in a panic. But here's the real reason silver matters. It exposes the lie faster. Gold is central bank money. Silver is industrial money with a rebel streak. When silver launches, it's the market screaming that the paper pricing system is losing control. So if we're right about 2026, central banks buying more, private investors returning, paper credibility cracking, silver becomes the amplifier. Now, one more layer, and this is where it stops being investing and starts being geopolitics. There's a world where a major bloc decides they're done playing on America's scoreboard. They don't just buy gold, they anchor to it. Not with speeches, with a number, a peg, a defined relationship where a unit of currency maps to a slice of gold. That sounds extreme, until you remember we already lived it. The dollar used to be as good as gold because you could convert it. That convertibility is what made the dollar the king. Remove convertibility and you remove the crown. Now imagine the reverse. A challenger currency offers a cleaner settlement path, even if it's only for trade between partners. No one needs to trust the issuer the way they trust paper. They just need the math to clear. If that happens, it doesn't have to replace the dollar overnight. It only has to siphon demand away, like a leak in a dam. At first, it's a trickle. Then the concrete starts talking. So here's where we keep ourselves honest. If we're wrong, where will it show first? Watch gold reserves. Watch trade settlement headlines. Watch treasury demand at auctions. Those are the early warning lights. And when they flash together, the everything is fine story dies fast, right in front. Now, we need to keep our heads. This is educational. We manage risk. We're not gambling. We're measuring. So let's lay out what we need to watch without drowning in 20 indicators. First, central bank behavior. Not what they say, what they do. If buying accelerates, it tells us trust is falling. Second, real rates and policy reactions. If the system needs suppression, the printing continues, and printing is gasoline for metals. Third, flow rotation. If capital moves out of treasuries and into gold, that's a regime shift, not a trade. Fourth, crypto stress. If liquidations spike, that's forced selling feeding the rotation. And fifth, price action in silver. Not because we worship charts, because silver is the lie detector. Now let me ask you something that should make you uncomfortable in a good way. If gold is up, but stocks are fine in dollars, are you actually richer, or did the ruler change? Because that's the trap. People measure wealth in a unit that's melting, and while they argue about points on an index, the adults are stacking metal. Here's the contradiction that's going to make 2026 loud. People will say everything is strong, while central banks behave like everything is weak. Which one do we believe? Now, remember that open loop. If gold becomes the final settlement again, what happens to dollar-priced everything? It means the world demands more dollars per unit of real stuff, commodities, energy, goods, assets. And that is how a currency crisis shows up, not as an announcement, as a shopping cart that gets lighter. So what do we do with that? We don't panic. We position. We stay focused on a few core truths. Fact, central banks are buying gold. Fact, fiat systems rely on confidence and suppression. Fact, private investors can flip from seller to buyer fast. Fact, leverage trades break hard when liquidity tightens. Interpretation, 2026 is a year where the store of value debate gets settled by behavior, not arguments. Now, here's the mistake most people make. They wait for permission. They want a headline that says, "Now is the time." That headline shows up after the move. By the time the crowd feels safe, the price is already higher, and the opportunity is already moved. So we have to think like adults. If the upside case strengthens when central banks keep buying and private money returns, then what's the downside case? The downside case is a temporary calm. A few months where markets pretend again. A few months where the crowd goes back to sleep. But even then, the metal doesn't vanish. The debt doesn't vanish. The printing doesn't vanish. It just gets delayed. And delays create bigger squeezes later. Now, before we go any further, I want you in the comments. Do you think 2026 is the year private investors finally chase gold again? And if crypto rolls over, where do you think that money runs first? Gold, silver, or something else? Drop your take below. We read it all. And quick CTA, if you want more breakdowns like this, hit subscribe. No fluff, just signals. Now here's the cliffhanger most people aren't ready for. If gold does push toward that doubling scenario, it won't just be a good year for metals. It will be a stress test for everything priced in paper. Companies, governments, banks, pensions. Because when the measuring stick breaks, everyone who borrowed in that unit starts sweating. So the question isn't, can gold go higher? The question is, if gold goes higher, what snaps first? And the answer to that decides whether silver hits $100 the calm way or the violent way. We're heading into a year where the market stops debating and starts choosing. Paper claims or real assets? Promises or metal? And the people who move first don't move because they're emotional. They move because they're early. Stay sharp, because the next wave won't announce itself.